Hey harvesters, and welcome to Project Premium Harvest. My name is Matt. In today's video, I'm going to be going over the options trades I have executed for April 21st, 2025. I'm going to be talking about my SPY daily covered calls I ran, the cash secured puts against NVIDIA, and then my weekly covered calls for the 200 shares of Oracle I own. So let's get started. For all of my returning subscribers and viewers, you guys know me. The first thing I'm going to talk about is my current account value. It's currently at $80,756.36. So let's navigate to SPY to have a overview for the last trading day. SPY lost about $12.44 in value, but in the overnight hours, it regained $1.93. I definitely think the S&P 500 and SPY, it's going to either trade neutral or negative the next couple of days, or until we get more positive news about the whole trade conflict. Besides the tariff situation getting resolved, is maybe we crush earnings for most of the big market players in the S&P 500. If they all come out with positive guidance or blown out past earnings and their revenues the highest it's ever been, there might be a case for traders to then reinvest back into the market. But until that happens, it's definitely going to be a hard sell, and we're going to have to be trading around a bear market. But now let's go over this spreadsheet. I'm going to talk about all the trades I've done. And then after we talk about the trades and the considerations I took for each trade, I'm actually going to start planning about what we can do tomorrow. And I'm going to show you guys how to execute those trades. So let's get going. April 21st was a pretty busy trading day, if you were to ask me. And let's just dive into it. So for my Oracle shares, I own about 235 shares of Oracle. And the way that covered call options trading work is you have to own 100 shares to have one contract. So since I have 200 shares of Oracle, I can run 2 covered calls against my shares. So what does that mean? So I was able to make about $46 between 2 covered calls that are a week long for Oracle. The current Oracle itself was trading at $126.95. It was a week long call. And then I chose a strike price that was about $10 away. So my thought process for my Oracle shares is this is a fund I want to hold long term. I do not actually want to sell out of it. So I'm choosing $10 or more, or super far out of the money covered calls. So because I don't want to get these shares assigned. And the whole premise behind this idea is, instead of my stock just sitting there and then not gaining, instead of having my stock sitting in my account and doing nothing, I'm trying to be proactive and squeezing out a little bit more income. This, $23 per contract's not much, ended up being $46 between the two, but that's $46 extra per week for just having the stock just sit in your account. So it's a way to squeeze more income. And that's kind of why, that's my thought process for my Oracle shares. For NVIDIA, I did 2 cash secured puts at the $93 strike price and the $92 strike price. And these are week-long calls. So I bought Monday, and then these are going to expire April 25th. The reason why I chose the 93 and the 92 strike price is because I was mixing in between a high enough premium, but also a number that I didn't think NVIDIA was going to hit by the end of the week. When I bought NVIDIA, or when I sold this cash secured put, an investor paid me money so that if the stock goes down to a specific threshold of this 93 or 92, I'm going to have to buy the shares at that price. And at the time, NVIDIA was trading at $98. So for me, thinking, oh, the stock might go down $5 or $6, I think that's a very good NVIDIA price. And even if this gets assigned, I'm just going to turn around and run covered calls at the money or a very aggressive amount so that I can sell out and then not use any more margin than I have to. Me running these cash secured puts, I made $247 of premium. I'm not using any margin this time to make $247. Robinhood right now is holding some collateral of my buying power hostage until the end of the week. So if at the end of the week, NVIDIA is nowhere near this $93 or $92 strike price, I keep that premium. I don't buy the shares, and I rinse and repeat next week and continuing to do that. However, if NVIDIA does go to a $92 or $93 strike price, then I'm obligated to buy the shares at this $92 or $93 mark. And then once I buy those shares at that $92, $93 mark, I'm probably just going to sell at the money, or maybe $2 or $3 above, so I can get a little bit of appreciation and then sell out. All right, now the moment we have been waiting for. So I own 200 shares of SPY. The first set of 100 shares I bought in at a price of $527. And the second set of SPY shares I own, their cost average is about the 540 mark. And this is important when you're running covered calls, because you don't ever really want to sell your shares at a loss, or you have to be very aware of the risks of picking a specific strike price that is below your cost basis. So let's get going. So for SPY, the first set of covered calls I ran was the 526 strike price. When the market opened today on April 21st, SPY was trading at $520.98. So I thought choosing a strike price that was $6 away from the money was relatively safe, and I didn't think it was actually going to hit, and I was right in that thesis. However, my second set of 100 shares, because the first set I made $68, but the second set I waited about 30 minutes after open, or about 45 minutes after open, and the S&P 500 jumped down to 514.90, and I chose a 527 strike price because my second set of 100 shares of SPY bought the 540, so I didn't want to get too far away from going way below my cost basis. So say this gets assigned, then I would lose about $1,300 of appreciation because I chose a strike price that was below my cost basis. I mean, I could technically just roll the covered call out. I can buy it and then choose a different one, but I would prefer not to have to do that because I work at an office all day and I'm not necessarily around my phone or my trading platform to like run options all day. Yeah, but that second price was a 527 and I made only $12. In hindsight, I probably could have chose it closer to 526, but I kind of wanted to space out my SPY daily covered calls. Therefore, that's the whole point of this project, right? We're trying to fine tune what right looks like. This market is bear market. But at the end of the day, with all of my trades today, I made $373 flat. So that's pretty good if you're to ask me. That's no NAV erosion. I took this $373 and what did I do? I bought as much SPY as I could. Every dollar I get from premium, I'm just investing in a SPY because I'm trying to get my next 100 shares of SPY and then next 100 shares of SPY. Eventually I'll have 1,000 shares. I can be running this daily and life will be good. I might not even have to work anymore. But that's the dream right now, is just to keep loading up on SPY shares so that I can continue by having more contracts and running more covered calls. All right, if I scroll over here to the options tracker, since starting this options trading either daily or weekly, I've made about $2,910.03. That's roughly 6 or 7, I think that's 7 trading days. So in about 3 more days, that would be about 2 full weeks of trading. So that is quite a lot of money for about 2 weeks of trading. Like I said, no NAV erosion. All this money I'm taking from these premiums, buying SPY with it, with the intent to buy more SPY shares to then eventually have more contracts. And then more contracts means I'm a free man from a W-2 income. As you guys can see, I'm at Spider S&P 500 ETFs. I'm going to go to my favorite section. It's the money printer button. It's the trade SPY option. So let's click on the money printer. Boom. And let's make sure we do sell call. The way you run covered calls is you have to click the sell call. If you do buy, that means you are, as an investor, putting upfront premium to buy specific shares at the assigned strike price. When you're selling, you need the 100 shares to run one contract. So let's dive into it. The share price for SPY is currently trading at $516.05. So ideally, whenever I run covered calls against my SPY shares, I want to choose something between $5 and $10 away from the current strike price. So $5 away from $516.05 is about $521. So this premium at this $1.12, that's going to net you about $112 of premium. I definitely think that's a number I definitely like, but because this is still a bit far away from my buying cost at that 527, it will be a game time decision of the risk I'm willing to put forth. If I can choose a strike price that is closer to my dollar cost average, I'm probably going to choose something like that. For if I were to see this $34 at this 527, I'll probably lock it in. And then if I want to get a little bit more wild, I might choose something at this 525 at this $50 mark. But it's really dependent on your risk. So for me, if I got these contracts assigned at this 525, I would probably go in and try to roll them as much as possible. So if the market had a bit of a green day, I would just buy back in. The buyback in would be at a loss, but then I would roll the options further away from that current price. So then eventually it would just be, I would even out. So that would be the thought process there. So I don't actually want to sell out of these S&P 500 shares. So that's kind of the strategy going into it. But to run this covered call, let's choose this 525. Maybe we'll do this 524. 524, click this plus button, continue, choose one. 62 cents. It's going to be about $62, and it shows it's going to be about $60 of profit. Review the order. Collateral is going to be the 100 shares of SPY, and we are going to submit. And then the SPY covered call is queued, so that means it's going to execute whenever the market opens tomorrow. If that 0.62 is a number that investor would like to pay you premium. So I'd probably do, yeah, maybe this 524. Maybe this 523 tomorrow. It really depends on when the market opens, if it's trending upwards in the green or if it's continuing downwards. If it continues downward, I'll probably hop on this 523 and also do a covered call on my second set of 100 shares. That's kind of the thought process of what I'm doing. The cash secured puts I ran for nvdy. They're a weekly, so the fact that I put them in is I pretty much just have to wait until either the end of the week or nvdy goes down to $93 and $92 for the strike price. And then if the investor wants to sign them, they will sign them, or they could wait till the end of the week. It's kind of hit and miss. And then Oracle shares, just pick something that's far out of the money, $10 away, trying to rack in a little bit more premium without just the funds, without the stock just sitting there doing nothing. So there's the video, guys. Hope you enjoyed it. Hope you learned something new. Let me know in the comment section what you guys want me to add in this. I'm trying to make this more helpful for you guys that aren't too familiar with options trading. So just let me know in the comment section. That's all I have for you today. Matt out, and I will see you in the next video.